pursue. So without further ado, let me turn it over to George Chao from Mannix Consulting, who is going to be our moderator and lead our panel on funding and cash flow. Join me in welcoming them.
Thank you, Beth. Hi, everybody. How are you guys doing? Good. You guys enjoy all the sessions so far? Great. Yeah. So today we definitely have three really outstanding VCs and also bankers, all that. So just want to introduce myself. So I'm with Mannix Consulting. So we are funded by the U.S. Department of Commerce NIST, the National Institute of Standard Technology. And then our goal is really to help local manufacturing company, supply chain, help small companies to get into bigger companies, and also startup companies on a lot of the hardware, because hardware is hard, right? And then so we can help company with all the SBIR, like California Energy Funds and all kinds of different alternative funding besides all the VCs and banks. So just here we'll be sharing that with you. And then just want to know a little bit, so how many of you actually are all your entrepreneurs, startup, like hardware entrepreneurs? Okay, good. How many of you are ventures or VCs, or how many of you are like small companies, small startups? Okay, great. Okay, yeah. So I'll let each one of them introduce themselves and go ahead, Elf.
Sure. So am I live out there? I can't. All right, perfect.
Yeah, you can.
So I'm ephraim Lindenbaum from Advanced Ventures, and I'm a recovering entrepreneur. So I've sat in all of your seats. I did that and exited here in Silicon Valley in 1999, a long time ago in the first dot-com boom. And the old joke is, when you exit as an entrepreneur in Silicon Valley, you have two choices. You either start your next company or default and become an investor. I didn't have any good ideas, so I became a VC, and we've been investing since 1999. We've been investing as it's relevant here in the hardware space since the founding of our fund, always in that category. We started with boxes and equipment closets, quickly moved into mobility and other areas like that. We just closed a hardware deal yesterday. So, it is alive and well, and it was not only a hardware deal, it was a female founder-led hardware deal. So what that basically means, there is nothing that's not on the table. And we are, great deals get done. In terms of this space, we love it. I mean, hardware, is a category that oftentimes feels like in Silicon Valley it's not appreciated, but when you look at it in diagnostics, in lots of different categories, it's incredibly meaningful. We have two current hardware companies that are out raising funds right now. One, as I mentioned, closed yesterday. The other's out there raising a large amount. So there's a huge trend going back to that. We historically invest in what we call late seed or Series A investments, so not quite the earliest, but at the same time, we're also very sensitive and always like with entrepreneurs like yourselves to talk about what makes a deal relevant to us as investors. What are we looking for? We've got a great panel with lots of other people that fill the gaps, but in our case, we'll spend some time talking about what makes a deal the right size for us.
Great. Next, June.
Perfect. You hear me okay? I'm a general partner at Joanne's Partners and a venture partner at Social Starts. For both funds, we have a strong focus of investing in health tech and as well as happy days. The core focus of the fund has been defined as investing delightful moments. The stage we focus is from the very early beginning. We got moment of inception to Series A. There's a strong hardware component in there. We invest in digital health, medical device, neurotechnology, as well as AR, VR application in health. So just did a quick count for the 30 plus companies we made investment for over the past 2 years. About a third of them has the hardware component. So really happy to be here.
Great, awesome. Okay, Eric?
Hi, I'm Eric. I'm the senior manager for Fremont Bank running the SBA lending. Not sure if anyone know that SBA stands for Small Business Administration. It's an arm, belongs to the US government for the missions of promoting small business. We have a phenomenal loan program called SBA 7A program. It's a general use business program, and it's for different purposes, startup, expansions, buying real estate properties, basically any type of legitimate business use. We have been in active lending to startups and expansions for Silicon Valley company for the last 2 years. Hardware companies, we like it because unlike software company, there's a lot of R&D in the beginning. For hardware companies, a lot of R&D at the time when we are looking at it, probably prototype is done, product is ready, and they just need to have some infusion so that they can mass manufacture that products. And they can become profitable in a year or two. So that's how SBA loans comes in and help the best because VCs, you're going to take a big chunk of their equity, which in turns that they only
Take a lot
need.
of risk to go with it.
Yes. So not saying that banks can take the risk level that you guys does, but the SBA stand behind the loan. So the government guarantees 75% of loan loss. In the case that if it's an export company that generate foreign income, the guarantee can be boosted up to 90%. So to a lot of banks, it's no-brainer to explore SBA financing for even startups or more risky companies.
All right. Okay, so since we're on the SBA, maybe we'll just jump in with the SBA. So I hear many startup founders, like they told me, in order to qualify for SBA, you need like 2 years of revenues or some kind of statement to show that you are will survive and also that. Maybe you can talk a little bit more about the requirement in those areas.
So let me give you a little background. So SBA loans, it's actually guaranteed by the government, but the actual money is still provided by the bank. And then 25% still like at risk. So, banks traditionally very careful, conservative in terms of lending. So every bank has their appetites or risk tolerance. So some banks, they say, okay, no startups. So what they look at is 2 years of history, operating history, and see if their profitability can support the loan. But SBA by itself, the guideline make it very clear that we can actually lend based on projections. So as long as the company can be profitable within 2 years and can support the loan within the 2 years time frame, given that everybody still get paid and they can still live with minimal salary.
But when you say profitable, does that mean the ability to repay the loan or actually be profitable?
Well, we repay the loan over a certain period of time frame, right? So payments. Right. So as long as they can support the payments, then it's okay.
Can they qualify with venture financing to support the payments?
So there is a requirement on ownerships. Okay, so very simple is if any particular owners owning 20% or more, then they have to be on the loan.
As guarantors.
And usually VC won't qualify because you're too wealthy. So you can actually carry the whole.
I don't know what that is.
Well, the fund itself is too wealthy that it can support the financing for the company. So usually, if it's VC already own more than 20% or more, in general, it doesn't qualify. So a company in the earlier stage, they have to make a decisions whether they can bootstrap and rely on bank financing. In that case, maybe they take in investor more careful and not to break that 20% mark. Otherwise, if they go along like the VC track and they have like 20% or more, one single owners, then normally they won't qualify down the road.
Okay, great. Yeah, and then so June, so you mentioned that your company has probably invested around 30 companies and 1/3 of them are hardware. So maybe can you talk about all of those 10 companies like what kind of criteria? Why did you guys invest into them? Or because we have many startup founders here who are who might be interested. So maybe you can share a little on why you guys decide and also that.
Absolutely. So I would say 1/3 of our investment has the hardware component, but I don't see myself as a hardware investor. We see our health tech investors. We focused on investing in solutions, not really the hardware or not.
Right.
So as a lot of investors say that hardware has a lot of risk associated with that, comparing to software solutions with more uncertainty on manufacturer distribution outcomes. But I think what we're looking for, like a lot of investors looking for, probably is a low unit economics, lower costs, higher margins, and the potential to reach to exceptional growth at a very fast speed. As we invest in the very early beginning inception stage, so several things we look at: a strong leadership, strong team, product and market fit, and for the technology or product itself is the differentiator and defensibility of it. A lot of my investments are around the medical part, healthcare part. Maybe one example is we led the investment of the previous round of a company called Epicor Systems. So what they developed is a skin-like microfluidic device with biochemistry component in there, with electronics components in there that can measure like sweat with a very small amount and generate the readings on a lot of biomarkers and give you an understanding of your body and how you do and to monitor disease progressions as well. It's very easy to scale, very low cost, and great unit economics. So that's why we made the bet on them.
Okay, great, awesome. So you said you just closed one company just recently. So maybe yesterday, exactly.
I'm still like hungover.
Yeah, exactly. Maybe
Not
you
in
can.
a good way.
Yeah, maybe you can talk a little bit more about why you guys invest in that company and talk a little about more on that.
Well, I mean, as Jun said, I think at the end of the day, we don't view it as a hardware versus software versus other. I mean, companies have to make sense from an investment standpoint.
Sure.
And I think what's great about this panel is it kind of gives you different looks as entrepreneurs of where capital can come from. And, VC is a good fit for someone, for some companies. Banks are a great fit for some companies. There's government financing. I mean, this is the greatest time in history to be an entrepreneur. I mean, I remember when I was an entrepreneur like forever ago, there was zero help. I mean, there were VCs and you had to go on bended knee to Sand Hill Road, and if you weren't raising a couple $1 million, forget it. Banks, I mean, you had to massive guarantees, zero risk, stuff like that. And, at the time, the government, we couldn't find any money. So it was really, really hard. Today, there's government money. There is an incubator for anything you ever wanted to do.
Yeah.
I mean, you could be like, we only do bizarre blah, blah, blah. There's an incubator somewhere that will give you free snacks, a killer desk, and an Arion chair, right? And, we now have like startups that go around and go, well, the snacks are better there, so we're going there as an incubator, right? Someone's going to give me 10 grand and all the food I can eat on that one, but they, they're got a better commute. I mean, it's crazy. So it's an awesome time. And for hardware, there are great incubators out there. Hardware, one of the challenges is it's harder for an entrepreneur to, develop your prototypes and get through some of your phases. And one of the issues historically with hardware is how do you get there? How do you get that prototype out the door so you can show someone what you want to do, particularly an investor? In our case, it's more of a customer, right? So when you look at that, that was a barrier for entry. Now, software, people at home on their laptop, they could code their own software, low barrier. But now that's changed. We've got all kinds of incubators out there. I mean, and from our perspective, I don't think we've seen an entrepreneur now that has not, who's come to us and said, well, geez, I can't bring you anything because, it's just too hard, too expensive. And, I think that's challenging from our standpoint. We want them to be able to get, as June said, product market fit, but also customer feedback. For us, the most meaningful part is talking to a prospective customer, or a real customer is even better. We want to see someone out there who's willing to write you as an entrepreneur a check for this. To us, that's like validation, right? And the more of them that are out there to write you a check, the better. And the bigger the market that you can attack, the better. And so I think one of the challenges that we're seeing more often than not in this kind of new environment of startups is it a venture deal or not? And I think, what we want to do as good stewards and former entrepreneurs is say, is your company going to be big enough to be relevant to June or I in the venture space? And so what's really important is to look at how big your market is. And is this something that, there's nothing wrong with having a 10 or 20 or $30 million company that's usually profitable, and you guys have a great time doing it, and that keeps our economy going, right? But that doesn't necessarily work for us in venture. So it's really important to understand, we have specific economics that we have to adhere to, but there are other options as well. So, that's something maybe in Q&As we can spend more time on.
Okay, great, yeah. So also I think the other thing is, I think Flextronics, Jabil, a lot of those big CMs, they have, if you are making hardware, and then usually you can look for them. Like usually I know they have venture funds also as well to help you make those things, the first prototype. And also we work with many other, contract manufacturing company in the Bay Area. Because I do know that all the hardware companies all thinking about, go to China to manufacturing all that. But we actually do have many big contract manufacturing companies here in the Bay Area. So I'll be happy to refer you guys to some of those contract manufacturing companies. They can help you make your first 1 to 1,000, 1 to 10,000, those prototypes here. Because, just flying to China, you might not be able to get all the, you have to fly there, and then, you need to find the right people.
You need to speak Chinese effectively,
exactly.
and secure your IP.
Yeah, and then you might lose all your IP.
Could eat a dog, it could get weird.
Exactly, yeah. So we do have many other, contract manufacturing company here in the Bay Area can help you, make your prototypes and so all that as well. So we can be one of those resources to help you as well.
And they have incubators. Some of them even
exactly,
have incubators. So they'll give you free office space, snacks, and build your stuff.
Yeah. And also there are many other, like California Energy Commission. If you have anything related to clean tech, all that, they have a lot of those. And also Department of Energy, and also a few of those federal, governments, they also have fundings for different, depends on your sector, all the different things, might have that. And then so maybe jumping back to Eric, so maybe you can talk about a little bit more on the pros and cons for SBA or.
Sure. So SBA loans, it's a loan, right? So it's not an equity financing. So one of the major advantages is you're not diluting ownerships. So you don't give up control, but at the same time, you're fully responsible for the loan. SBA require the owners 20% or more to provide a personal guarantee. Mm-hmm. So not only the corporate level, then whoever the owner, majority owners, then they need to be responsible. If the owners has equity on their property, then SBA require lenders to put a junior lien up to the loan amounts onto their property. All right. So in turns, this is like people's money. It's taxpayer money. So if there's a way that we can recoup any loss, then SBA mandates the bank to do so. Mm-hmm. Okay. So that's the main difference. And there's also some other beneficial factor is there's pretty long repayment terms. So for example, a general business loan, you can have a 10 years term. So fully amortized over 10 years is fairly easy to handle. And say if you have a big order, you fulfill it, the loan is still there. And you don't have to repay immediately. Although if there's repayments happens, there's no prepayment penalty. You can actually take on other contracts and keep using the funds for financing it. Mm-hmm. So that's the beauty, and there's a flexibility. And of course, the most important one is there's no giving up of control and equity.
Mm-hmm. Okay, I see. So June, so you are more on the earlier side. So your company invests 100,000 to 500,000 that area, and also even your company invests bigger, probably like $1 million to $3 million. So what do you guys see the trend, for like now in Silicon Valley? We know like Zoom just IPO today, and then you have Lyft just IPO, and then Uber is going to IPO. What do you guys see all the hardwares right now, like whether it's in Silicon Valley or in US, like the whole big trend for all the hardwares?
I can only speak of the areas that I'm familiar with, which is the hardware application in health. So what we're seeing is there's a big trend of increasing use of the sensors to monitor the health. For healthcare, it's moving on to a value-based care. So people are working on products to generate more value faster, cheaper, and more scalable. Right. So for people are not satisfied as previously going to the hospital 10 minutes, take a test, and get the results about themselves. They want to control the data. They want to see more data and continuous monitoring. So for that, a sensor, wearable, all kinds of intervention monitoring solutions are being used right now. Like I think one great example is Stanford iRhythm, which IPO'd a couple of years ago, and that moved the 10 minutes test at hospital to 2 weeks monitoring, continuous monitoring for the cardiovascular disease and conditions. So that's basically what I've seen. And I also see AR, VR, even though adoption for consumer side is slow, the application in health has been emphasized on the value that AR, VR could be creating for that. We've just made one investment called Iris Vision, using like a mixed VR solution to treat for the extreme low vision patients, and ophthalmology feedback has been extremely positive, and user feedback has been very positive. VA 100% reimbursed on that. Last year, like couple of $1 million, you know, like growing to a very good trajectory through.
Okay. Okay. Oh, what do you see?
So, I think probably more so than ever, the Valley's become a little tired of the buzzword, right? There, I think the crypto phase was kind of like the nail in the buzzword coffin after a number of VCs, and more importantly, funds were spun up around capturing some of that. So I think from our standpoint, we're really looking for meaningful companies that are defensible. I mean, I don't think we're focused on disrupting any one particular category any longer. We're active because we're good at a couple of categories. Digital health, like my colleague June is here. Financial technology, we've had a lot of exits. But also categories like food and agriculture. I mean, these are solving big problems in the world. And, to our belief, I mean, solving big problems is what venture is about.
Right.
So if you're finding a way to solve that, we're willing to look at most anything. I think the overarching issue we found is that trying to be the cutting edge isn't always the best thing. I mean, look at Zoom. Zoom's the best answer ever. They're like the third or fourth wave of movers in video conferencing. I mean, there were literally IPOs and M&As in that category when we started in venture 20 years ago. And one went public this week. And it's just not that different from anybody else. So, at the end of the day, good companies can come around again and again and again. So what we're really looking for are great entrepreneurs, having the right size of market, and to June's point earlier, it's explosive growth. I mean, the killer for us on the venture side is slow adoption. We're on a finite timetable. You have to understand, we work for people. And, we effectively are stewards for our limited partners, our investors' money. So we have to deliver just like you have to deliver. And we're on a 10-year time clock at the longest, most VCs, which means that we have 10 years from the founding of our fund to invest that money and return that capital. Okay, which means if a company is growing too slow and it gets outside of that window, it doesn't matter. That's like scoring a touchdown 1 minute after the game's over. It doesn't matter to anybody. So for us, we really need to bring that, that growth cycle in fast enough. We want to see companies that are explosive. The company I was mentioning yesterday, they were self-funded. They were founded in 2016. They had revenue their first year. Their second, their first true full year in operations, they did $700,000 in revenue. And this is their first institutional round of capital. They had not taken any capital in to date. That's what we're looking for. They're going to do $2 million this year and are on track for $7 million the following. And that's not just like projected numbers if everything maybe works out okay. This is like a visible pipeline to revenue. So that's what we're looking for. I mean, and at that point, when you start to see that says that's a pants on fire problem. I mean, this is something that they're solving that's here and now and today. And that's what we want to see. Not a nice to have solution, not, well, geez, if these 3 things work out, people will use our stuff. No, we want the biggest problem that you can solve, and we want it to be on fire, and we want you to solve it.
Great. So, the rest of the time, we'll probably open to do Q&A. So if any one of you, so basically we have 2 VCs and a bank, and also I'm more kind of like on the federal state side. So if any of you, any questions, you guys can raise your hand, and we have mics can go around and ask.
So this is actually really interesting that we, in addition to the venture capitalists, that we've got alternate funding sources. And I think that this is actually a really particularly interesting right before our pitch fest, because with our pitch companies here, we often tell them that if you don't ever project to make over $40 million a year, you're not likely venture funded or fundable, right? One of the things I want to ask our VCs, and then and then back to the two of you that are doing non-venture, is when you see like a non-dilutive funding round, either from a government or bank loans. I mean, you just mentioned the company that you took your first institutional money. What does that mean to you in your estimation of that company? How does that increase your valuation of it and the team and the founders?
I would say that's a good thing. Non-dilutive funding is always good. A lot of the company we made investment are also like originated from institutions or universities where they have a lot of grant money to support the research of that, and that's have been like generating a lot of values for the technology and IP side.
So, I mean, look, we love free money. Let's just be clear about it. You get free money, we're all in. Sounds great. The short story of that is, oftentimes it's not free. So you just have to have the skill and the ability to manage that, right? Which means, non-dilutive funding from grant bases are great as long as the IP issues there, right, are managed well, meaning that the government doesn't have a first right, that you don't end up with a PR issue because they're using your software to go kill people. I mean, there are lots of great ways to get money, but you just have to make sure they're easy ways. But there are all of these new programs, starting with kind of the NIST money that's out there. There's free help you can get now where the government is funding sort of entrepreneur support groups out there. There is so much that you can really, add to your quiver. And to not take advantage of it as an entrepreneur is silly, in my opinion, right? Then when you get to SBA funding, I mean, to Eric's point, it's got a lot easier. I mean, it used to be a total grind. There was this expectation that it's really, really hard. It's got a lot easier. I mean, it's still really hard, and you're still signing up. And to Beth's point, though, the challenges that we see when we get into that is that they've got this security interest on the company, right? Which means if you don't pay them back, they get to take your company. So in our case, it's not going to be a blocker, but what we are going to do is we're going to say we have to pay that off upon closing. That means if we give you $2 million and you borrowed $500 from Eric, we're going to make you take $500,000 of the $2 million we give you and pay off Eric tomorrow. Now, you can go to then Eric in his Fremont Bank versus SBA lender hat, and then he can put the money there and he can give you a credit line on more, traditional terms. But that is something to keep in mind. But there's no reason not to. And, this is government money. It's government guaranteed. There's plenty of foundation money if you've got a social enterprise out there. I mean, there's a great amount of options.
I think there's also SBDC. I think they are everywhere as well. They can
I
give
have
you
no idea what that means.
Yeah.
What
There's
does
a
that mean?
small business development center.
Oh, good. Okay.
So they have one in San Jose. They have one in San Francisco. Almost every city, the major city, has some SBDC. They help you, a lot more alternative financing model as well. And then
that's a good point, modeling. So
yeah.
That's something that not everybody happened to be a financial whiz, and financial modeling is really important to us. We really need you to understand your business, kind of top down, bottom up, understand what that means. So, those are areas where you can tap into like a finance professional for free.
Yeah.
If you don't have like a great personal network to help you, that can be really, really helpful there.
Right. So they help you prepare so you guys can get ready to meet the VCs, all that. So, I mean, I think a lot of those are kind of like free service that you guys can tap into. And then I think with the state of California having a lot of surpluses, actually they are getting a lot more of those money can give to a lot of the startup companies here. And then so that's definitely one area.
So George, I want to add to that. So for SBA financing, it's ranging from $50,000 all the way to $5 million. So if we are talking about incremental financing, so say if we initially finance some money, and you're getting to a point that you generate some revenue, but you really need a big boost, and you can come back and ask for more. So it's always, the door is open for subsequent financing. It's not one time. The cap is, for 7A program, is $5 million. And I think that's a lot
That's a
more
ton.
than.
Yeah, and
Love
you know, and it's really great. I mean, look, if your business is going to take 4 years to get your prototype and your first customer, go to talk to Eric because there's a high probability. No, there's no negative. As long as you pay Eric back, he's happy, right? Me, I need like 10x return.
Yeah.
So like 4 years from now, I mean, we've moved on. I mean, like we're gone. We're maybe calling you back after 4 years. So, all right, there were more questions.
Any other questions? Yeah, go ahead.
I think this is mostly targeting the VCs. When you invest in a new company, either at the very early stage or just after
Wait,
that.
closer.
Is this good? Great, thank you. My question is sort of about what you provide in terms of like regulatory guidance to the companies that you invest in. So especially when you're thinking about medical in that really early stage, there are probably people who really don't know or really don't have a sense for FDA pathways, but then also true for any other kind of hardware company. I feel like in hardware, something that's really important is regulatory, and you might have companies that don't have a full sense of that.
Yeah, I'm happy to take it. Okay, so like we don't help. No, just kidding. You got to do it on your. No, we do add value, but that's not often the way we do. I mean, some of us, if you're, let's say, talking about drug development or FDA compliance, I mean, we've probably done that before, so we probably can tell you, and it's probably better to take us out to coffee and learn about the good and the bad and the ugly of that, and then we'll probably refer you to a consultant who's probably an expert at that, because we know a very little bit about a lot of things. And so, but regulatory is something, we're active investors in the broad space they call cannabis today, which is fraught with regulatory challenges, right? However, having been in medical device, particularly 510K, it's really not that bad, actually, I mean, compared to the government side of things. So, we can be helpful. I mean, someone like June, who knows the space incredibly well, I mean, you probably know off the top of your head, like, a bunch of, FDA-related stuff, no?
I've been talking to a lot, but I'm
Yeah.
not. I would also, like you just mentioned, suggest them to have a consultant to work with them,
Yeah.
more professional.
Totally. Come to us and learn all the bad stories, how companies like got crashed and burned because they didn't do this, and then just don't do that. That's really what we would say. But we
yeah.
try. And we'll introduce you to a lot of other entrepreneurs who've been through this. And I think one of the greatest things is, you learn from the experiences of other entrepreneurs, and in my case, I was an entrepreneur. I probably did it wrong myself, so I probably, that you can definitely trust me on. So, we're happy to add value there. But as a whole, that's not necessarily our job. And there are a lot of VCs that are not keen on that today. That, I had lunch with one the other day. He was like, I'm not a millennial VC. I am not a coach. I am not your parent. I wrote you a check. I'm going to see you once every 3 months, and you better be like doing your job. And then again, I've got other ones that I talk to our CEOs almost daily. So it's
All right.
over.
So our time is up, but I do want to thank every one of you, and I think we do want to see next year you guys come back and then tell us some success story. So do come to talk to VCs and also Eric or me. We can share with you all the other financing options that can help you success. So good luck, everybody.
Thank you. Good luck to you guys.